Well, 10-year yields, they took a big leg down today, primarily on that weaker sentiment data. But if rates do rise from here, it could mean big shifts on where certain stocks are headed. Let's dive into the charts with the Chartmaster. Carter, take it away.
Sure. I mean, before looking at the charts, just to be clear, I am forever and always in the camp that the cost of 10-year money being at 1.2 or 1.4, 1.6 or 1.1, 1.5 or has nothing to do with the 3 to 5 year DCF work and assigning a multiple to a growth stock. However, the market seems to think that it matters a lot, and on any given day it does. Let's look at some charts. First, two yield charts. The first is just the 10-year yield chart as we all know it and see it, no judgments or annotations by me. The second is with the lines as my eye sees it, which is to say the move down since 1.77 has been very orderly. We know we hit 1.12 about a month ago in mid-July. But interestingly, when we rallied to 1.38 this week, we hit our head to the penny at that upper band of the downward sloping channel. And we closed today at 1.28, a real setback for those in the camp that were heading higher. In fact, consensus is still close to 2% at the end of the year for 10-year yields. I do not believe that's going to play out. In any event, let's look at some tech names, a few charts. First is just the tech sector itself. This is the XLK, the way to capture the whole sector. And how would you characterize it? I would call that an uptrend. There's not much else to say, yes? And so it's a stay long, be long circumstance, if you will. Now, two stocks. A stock that looks a lot like the sector, look at HubSpot's next chart, HUBS, up and to the right. North by northeast, orderly, steadily, never gets too steep. A classic stay long, be long looks like the sector. It's a favorite. And then to end with MongoDB, a software name also. This has been a laggard, and yet the setup, you can call it whatever you want to call it. I've annotated it there like a head and shoulders bottom. But the point is, this is poised, I believe, to play catch up with the sector and to deliver some outright up performance on its own.
All right, good charts there from Carter Worth. Let's trade this. Bonawyn, how much do rates play into everything?
You know, I actually think the rate thing has been spoken about ad nauseum, and it's, I don't know, I feel like we've distilled it down and oversimplified that. For me, I'm actually looking more at credit spreads, right? So you have rates, we're talking about the 2-10 yield and how it's going to affect banks, how the longer end of the curve is sentiment around GDP and growth prospects. But for me, it's really about the Fed, and I know you are tired of hearing about them, but it's really about them striking a delicate balance between tapering asset purchases and high yield purchases and what they're going to do with their target rate. Because as you can see from a lot of data, like when we have rollovers or spreading or widening in the credit market, particularly the high yield credit market, that trickles down and correlates much better with small businesses and how they're going to continue. Like those have been the companies that have not had the same access to credit and low rates that these large behemoth companies have. Those are the things that I'm focusing on more than just any particular rate, but how rates trickle down into different credit pockets in the market.
Yeah, good stuff. And Nadine, I want to be clear. I mean, I've been tired of talking about the Fed since the Ben Bernanke. I used to have a Fed jar on set on a show called Street Signs. Every time someone brought it up, they had to throw $1 in it because I feel like it's just an easy excuse. I understand how much it matters, right? But it's like my least favorite saying is, it is what it is. It's like, you're not saying anything, right? The Federal Reserve is a convenient excuse for everything. Stocks go up, it's the Fed's fault. Stocks go down, it's the Fed's fault. That's my point there. Still, rates do matter. What are you watching in the rates market? What kind of stuff do you think will happen if rates do go up?
I think there's two things. One is there's a misunderstanding that when tapering occurs, rates don't just jump up. Usually before that is when rates have gone up. And you actually usually see rates go down after tapering post QE. And so if you think that tech is still going to be a bond-like security, then it actually should benefit tech. So I agree with Carter on this. Looking at tech, it's in a bullish formation. It should continue. And the second point, if you want to bring up the chart about implied volatility, we like to look at the options markets. And what you see here is about where people are actually positioned. You've got the QQQ, so that's tech, at a 55% implied volatility premium. It means people are paying up for protection. Same thing with MGK, which is mega cap growth, 44%. But then you look at the red bars, the small bars, and what you have there is the XLF. The financials are actually at a discount, minus 20. So people are already positioned as if rates are going up. And Carter mentioned people are thinking it's going to be at 2% for the 10-year. And we're on the opposite of that. We actually would take the contrarian view and say go long tech because people are already positioned on the opposite side.